Hello and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Shibani Sircar Kurian. She's Senior Fund Manager and Head of Equity Research at Kotak Mahindra Mutual Fund. Welcome, Shibani.
Hello, everyone. Always a pleasure to be on your show. Looking forward to the interaction.
Great. Good to have you here. Now, to begin the conversation, Shibani, if you could share with us what sparked your interest in equity investing?
So let me take you a long while back. I've spent more than 2 decades in the capital markets. But my interest in equity markets actually started way back when I was in school. It was a simple thing that we used to do every day in terms of my father asking us to read the Economic Times and other newspapers. So it was at a point in time when, of course, a lot that was written in the newspapers, especially the business dailies, these were things that we didn't really understand. However, it did spark a lot of interest where, markets, economy, etc. were concerned. Usually what happens is most children in the year 11th and 12th take up science. I did really well in my 10th. However, I decided that in 11th and 12th, I would take up economics, maths, and accounts as my subjects. And, to my surprise, I really enjoyed these subjects. And therefore, I decided that this was my career path. I pursued economics in my undergraduate course at St. Xavier's in Kolkata. And then I went on to do my MBA in finance. So I think it started off very early, though, of course, as a young child, you don't know where life really takes you. But the interest and the spark was set alight in those early days when I started reading the business dailies at the insistence of my father.
Shivani, after doing your MBA, you joined UTI Mutual Fund as in the research team, then worked as a wealth management in a wealth management firm, and later with the Kotak AMC. Could you just help me out? How has this various role shaped your investment strategy?
Absolutely. So, if you look at my career path, I would say that this is possibly an ideal career path if I look back for somebody who wants to take up fund management as a role. So when I got my placement in UTI Mutual Fund straight out of campus post my MBA, I started working in the equity research team, started tracking sectors such as banking, financial services. Then, after almost 6 years, I moved to Donaday AV Financial Services, which was an analytics and a wealth management firm. So, a lot of the research that we were doing there was more sell side rather than buy side. However, I realized that my calling was more towards the buy side where I wanted to manage money. And hence, in 2007, I moved to Kotak Mutual Fund, again as an analyst, tracking the BFSI sector. Since then, I also tracked the technology space. And then finally in 2015, I took over as head of research. And then in 2018, I got the opportunity to start managing funds. So that's been my career progression. I think what also helps is that when you have a research background and when you have tracked companies and sectors in depth for a period of time, that helps you analyze not only companies in your sector, but it also sets the foundation in terms of how you look at companies overall. And therefore, that philosophy plays through in terms of portfolio construct as well. I think also what's helped is that in Kotak over the last almost 17 years, we've had a pretty well-defined investment process and philosophy that also feeds into the way we manage funds. And I think it's been a culmination of the overall role, the kind of experience that you've gained over the last 20, now actually 24 years. And all of that flows into the investment process and philosophy that you bring to the table in terms of managing your portfolio as well.
Right. So, Shivani, looking back, if you could share with us, what are some of those key lessons or pivotal moments that have, defined your career or shaped your career in the way it has?
So I think I can, Ruchira, when I look back, there will be many points in time when markets have been volatile. And given the fact that over the last 2 decades, we've experienced periods of extreme volatility, global events which have impacted our markets. I think all these events that have happened, whether, I started my career in the year 2000, which was the Y2K year. Then, of course, you had 2007-8, which was the Lehman crisis. And most importantly, and very interestingly, I joined Kotak in November of 2007. And just after that, the Lehman crisis unfolded. And then, of course, you had the taper tantrum, COVID. And so we've lived through various periods. I think what has taught me, and my biggest takeaway from all these periods of volatility, is that, as a fund manager or even as a research analyst, we are always endeavoring, or we are in the quest to find stocks which are multi-baggers, right? Which give you upside. But at the same time, we must not lose sight of downside risk. And therefore, avoiding pitfalls is as important in managing your portfolio as looking at or evaluating ideas which can give you upside potential and help you create alpha. Remember, creating alpha is not only about upsides, it's also managing your downside risk. And therefore, risk management and taking a risk adjusted approach to portfolio is my biggest takeaway, having lived through these periods of volatility. Remember, we are in equity markets. Long-term trend is on the up move. But how you navigate these periods of sharp volatility is what ultimately shapes your portfolio performance on a more structural basis over the long term. So, in a simple sentence, manage your downside risk in the search of upside. That's my biggest takeaway.
Shibani, coming to specific to your fund management style, your investment strategy, could you explain what's the style of your management? How do you manage the money? And given your experience over of 2 decades, how means has it changed over the period of time? Any this style of managing money?
So my style of managing money, I think, has been shaped to a great extent by the team and the investment philosophy and the process that we've imbibed at Kotak Mutual Fund. Of course, when I started off in UTI, at that point in time, I was a research analyst and very, very new to the job. And as over a period of time, you realize that there are different strategies that can be followed where fund management and portfolio management is concerned. And I would say that, the way we manage money at Kotak Mutual Fund, given that I've spent my longest in terms of my career at this fund house, a lot of that has influenced the way I look at equities, stocks, and portfolio management. So, put it in a nutshell, the investment philosophy is buying high growth, high quality companies, but trading at reasonable valuations. So, it's GARP, but with an overlay of quality. What we've always done, and the investment philosophy that I typically employ, is that number one, your starting point of any evaluation should not be, the multiple. So the mistake that we often make is we fall into value traps by trying to only find companies which are trading at multiples which are attractive. Hence, the starting point of evaluation of any company in your portfolio has to be the business. The way I approach it is look at businesses which are scalable in nature, companies which are gaining market share in the environment in which they are operating, and therefore this market share gain should be scalable and sustainable. The second most important factor is quality, and quality imbibes corporate governance. It imbibes capital allocation, and finally, companies which are friendly or which keep in mind minority shareholder interest, right? So that has to be the main criteria. And as we were discussing in our earlier question, this aspect of evaluating a company helps you avoid pitfalls in periods of volatility. And the third factor is valuation. And valuation for me is not just a multiple. I've always stated that valuations have to be looked at in conjunction with earnings growth as well as return ratio profile. So I manage focused equity. As a starting point, for instance, we look at companies where return on capital employed is greater than cost of capital. That means that these are companies that inherently are returning back to the equity investor by generating adequate return over the cost of equity. So in a nutshell, if you ask me, my investment philosophy is growth and quality, but at a reasonable price.
But Shibani, how does the sectoral call comes into this? How do you select the stocks in the portfolio?
So we have been always good bottom-up stock pickers. So at Kotak Mutual Fund, we have now a 17-member research team, which I also head. So our philosophy has been bottom-up stock picking, but with a top-down thematic overlay. And when I say top-down thematic overlay, that is what helps us select sectors. So let me just explain that to you. Now, we are not taking sectoral calls just in isolation. We are trying to identify themes. And then within the theme, identify the sectors which help us best play those strategic ideas. So to give you an example, Post-COVID, what we saw is public sector capex, for example, center, then followed by state, picked up considerably and investment rates were moving up. Therefore, we took a view that growth would incrementally be driven by investments over consumption. Hence, if you looked at our portfolio, over a long period of time, we've been significantly overweight on sectors such as manufacturing, capital goods, and infrastructure. So that was a theme. It can be a theme like private versus public. It can be a theme like rural versus urban. It can be exports vis-a-vis domestic growth. So once you identify a theme, you are then able to identify the sectors which will help you best play that particular theme across your portfolios. So that's how we look at top down. And once we've identified that, we go bottom up. So there is no constraint in terms of what kind of stocks that you own. Depending upon the portfolio and the strategy that you are managing, we try to identify which should be the best stocks to play that sector or the theme. So that's how the construct of the portfolio typically works when we are looking at the overall methodology. Of course, each portfolio strategy will be different depending upon what the constraints, etc. are.
Shivani, one more thing. If I've spoken to the various fund managers like Harsha or Atul, they all focus on the GARP as a strategy, and even Kotak looks at the GARP as a strategy. So apart from this, do you have a personal thing because you manage a focused fund and a contra fund? So do you are a little bit value biased, or is it only because that you are at Kotak you look at the GARP strategy?
No, so I think that at any point in time, buying a good stock but at a reasonable valuation is better than buying an average stock but at very high valuation. So that's the philosophy that I've worked with. That philosophy helps me in construct the portfolio both in terms of contra as well as value, as well as focused. Now, contra is a value biased fund, but there is an element of growth on top of value. And let me explain that to you. So when we start off in terms of the universe of stocks that we choose for contra, these are stocks that should have either underperformed the index, or it can be a company that is trading at multiples which are lower than its own history. It can be a sector that has underperformed, or it can be a stock that is trading at multiples which is lower than its peers in a sector. So there is a value bias to the universe of stocks that we are creating. Now, on top of that universe, when we are actually constructing the portfolio, there is a fundamental GARP strategy which is overlaid on it. So somewhere, while there is a value bias to the portfolio, but there is also an overlay of GARP or growth in terms of the companies, turnaround of companies, management quality, changes in companies that will help it in terms of multiples re-rate. So if you look at Contra, for instance, the PE of the fund is lower than the PE of the benchmark on a 1-year forward basis, but the return on equity of the portfolio is higher than the return on equity of the benchmark. Now that means that while there is a value bias, because of the overlay of GARP on top of it, it is helping us select stocks that finally generate higher return on equity. And therefore, as a portfolio, we have high quality companies which are typically generating higher ROEs than the benchmark, which is NSE 500 for the portfolio.
Now, Shivani, if you could also share with us, how has your research background influenced your fund management decisions?
So I continue to do some amount of research even today. So I still do track some part of the banking financial services sector, specifically some of the large banks. I think research and being a research analyst is very, very important or having some background in research is important when you want to become a portfolio manager. Now, one philosophy that I've always imbibed is when you're looking at stock picking in your portfolio, a majority of your portfolio should comprise of stocks where you are taking structural views over the next 1 to 2 years. There will be some small element of the portfolio where you may take tactical calls, but that should not be the majority of your portfolio. And the structural part of the portfolio where either you are seeing multiples re-rate or there is a compounding play, this part of the portfolio finally helps you generate alpha over a longer period of time where the benchmark is concerned. And that part of the portfolio construct comes more naturally given the fact that you have looked at stocks from a research angle for a long period of time. The other thing that we were talking about in terms of avoiding pitfalls. Now, as a research analyst, this is something that we do for all the stocks that we cover. And this is something that we continue to do. is that we undertake a forensic analysis of all companies at least once a year when the annual reports come out. And this holds true for any new company that is either coming into the research universe. So that helps you to look beyond just earnings and reported numbers and to dig deeper to understand the strength of balance sheet and cash flows, and therefore take a longer term structural view where companies are concerned. And I think that has helped us considerably in terms of portfolio construct and outcomes of the portfolio as well.
Shibani, you in the previous question you mentioned about the strategy of the Contra Fund, and could you little bit elaborate more on this? Because if I look at the portfolio of this fund and top 10 holdings, all are the well-known names. It doesn't look like a value biased or a tilted towards Contra. Barring one private sector bank which has not done well. Apart from that, all the stocks have done very well in the last 1 year. So what's the overall thing, in this
So
scheme?
it's a good thing that the stocks have done well in the last 1 year because that has helped generate the alpha over the
Yeah.
benchmark. But as I said that, Contra as a strategy is a value bias strategy, but it is not a value only strategy, right? So when you are picking stocks, you constitute a universe of companies which have underperformed, which are trading at multiples lower than their own history. But you're also then trying to identify companies which are inherently growth companies. There might have something that have gone wrong either for the sector or for that company specifically, which has resulted in underperforming the index. So that's the overall thought process. It can also be a company which today is trading at multiples below its peers in a particular sector, or it could also be a sector that has underperformed. And therefore, we are always in the hunt of looking at sectors where there is now potential for re-rating from a sectoral perspective as well. So these are all these factors that go in terms of identifying stocks where Contra goes. Now, like I said, it is value biased. So we will not buy stocks which are trading at valuations which are significantly higher than its peers in a particular industry or vis-a-vis the benchmark itself. And that is reflected in the fact that the valuations of the portfolio itself on a PE basis is lower than the valuation of the benchmark. So that's where the value bias comes in. Again, as a strategy, we are essentially looking at companies which are maybe either going to see improvement in terms of their growth profile, return ratios, and that feeds into multiples re-rate for the company. So the way Contra really plays is that one, in periods of volatility, if you have a market such as current markets, because the PE of the fund is typically lower than the benchmark PE, there is some underlying support, and therefore that helps in periods of volatility. And the second thing that we talk about when Contra is concerned is that you have to give time, because these are companies that are today maybe trading cheap. And finally, there may be something that is changing in terms of the multiples re-rate over a period of time. Having said that, if you look at the portfolio, the construct of the portfolio is such that at the time of buying a particular stock, it has to fulfill those 4-5 criteria that I had outlined. However, in the portfolio, just because a stock has performed, it is not necessary that we exit that stock. We will keep evaluating that stock over periods of time. If we believe that there is still some upside left in the stock based on our research outputs, we will continue to hold the stock. And therefore, the portfolio construct is such that at the time of building the portfolio, it has to fulfill those 5 criteria, which makes it contrarian and true contrarian in nature. And then over a period of time, we keep evaluating the stocks in the portfolio, which is why maybe some of the stocks which are there have already performed, but we still believe that there is some upside still left, which is why it's still in the portfolio.
Right now, moving to your focused fund. So it has shown signs of improvement in 2024 after facing some challenges in 2023. So if you could share with us what key changes or strategies have you implemented to drive this turnaround?
So focused as a category is a tough category because you're finally picking 30 stocks at max. And these are stocks which you believe are companies which are structural in nature. So the element of being tactical does not, is there room to be tactical does not apply, or there's no room in the portfolio. So let me explain how focused as a strategy works and how we construct the portfolio. So here, we more than other portfolios, the GARP philosophy plays through in the portfolio. So typically, if you look at India today, India will have somewhere between 5,000 plus listed entities. If you narrow it down to say companies with more than 1,500 crore market cap or 1,000 crore market cap, there will be another say 1,500 companies. In our research coverage today, we have about 525 odd companies. And a typical diversified portfolio that we run at Kotak will have anywhere between say 50 to 60 stocks. But then there is one more layer of filter that goes into construct of focus where we will choose 30 stocks. So these are 30 best stock ideas that we have from our overall research coverage. So what we are looking at companies which are gaining market share, companies where, as I said, cost of equity should be lower than the return on capital employed. That means ROC generated by the company is higher than the return on equity, cost of equity. These are companies where management quality is good, and then they are trading at reasonable valuations. So when we are buying stocks in focused as a strategy, we are buying it clearly with a 18 to 24 month time horizon. So it could be that given that it is a very concentrated portfolio, you will see periods of time when you will have to be patient because the stock will perform, but it will perform hopefully over a period of time. So that's the entire concept of focused. Of course, of late, if you would have seen that on a 1 year basis, we are generating alpha over the benchmark. Since inception, we have generated alpha over the benchmark. On a 3 year and 5 year basis, we are more or less in line with the benchmark today. The other factor that we must also look at when we are looking at focused is obviously over a 5 year period, there has been a change in benchmark itself, which we need to take into account when we are looking at alpha. But ultimately, these are high growth, high quality stocks, which when we have entered into are trading at reasonable valuations. And therefore, the portfolio is comprised of portfolio stocks, which are possibly the best ideas that you have from the fund house and the research team. And we believe that once needs to be a little patient where this particular strategy is concerned.
But Shibani, is this a completely sector agnostic fund, or how do you top down this thing and select the stocks in this thing?
So it's a market cap agnostic. It is a sector agnostic fund. So while we do have a benchmark, which is NSE 500, the benchmark is a broad benchmark, and therefore we are selecting 30 best stock ideas. We will keep an eye in terms of sectoral composition of the benchmark, but that does not have a constraint in terms of composing the portfolio or constructing the portfolio. So it is, if you look at it, it is a true bottom-up strategy. When these are best ideas across mid, large, small caps, based on our view in terms of which market cap criteria you want to be, what's the upside and downside in a particular stock, and therefore the portfolio is constructed. We do, of course, keep an eye on the benchmark, but given that it is NSE 500, it's a broad benchmark, so it's very, very difficult to, adhere to or replicate in any form. The other thing that we do when we are constructing the portfolio, because it's so bottom up, supposing there are two stocks, A and B, internally we will have bull case and bear case target prices and base case target prices for all stocks that we cover. Therefore, if there is a stock which has an upside of say 30%, but also has a downside risk from a bear case of say 15%, vis-a-vis a stock which has an upside of say 20%, but a downside of say 5%, we would rather then be in stock B, because then the downside risk to upside risk is more measured rather than in stock A. So we do that for all the stocks that we have in our portfolio in trying to see what is the best case outcome from a bull perspective and also bear case outcome, and then comprise the 30 stocks in the portfolio.
Shibani, now coming to the markets, in the last 2-3 years, we had seen the bull market, and right now we are going through some volatility. Do you believe this is a consolidation phase, or do you believe that the markets are likely to correct more, or this is a temporary phenomena?
So I think Indian markets, if you look at structurally, are fairly well placed. While we will, after seeing such a great outperformance over the last 3 year period, both on an absolute basis as well as relatively, it is but natural to see some degree of consolidation and volatility. Now, why I say structurally Indian markets are well placed is twofold. One, if you look at India's growth on a slightly longer term basis, while of course near term quarter macro has seen some slowdown in terms of growth, India continues to be among the fastest growing economies of the world. The most important factor for me is that corporate sector in terms of balance sheet health is possibly at its best than it has been ever since at least I started tracking equities. You've seen debt come down. There has been significant deleveraging. And today, if you look at India, ROEs of India is possibly close to its highest level that it has been. If you look at any index, more than 30% of the index in terms of the number of stocks are possibly reporting return on equity, which is higher than 14-15%. So it's a fairly good, strong corporate outcome that we have today. Now, in the near term, of course, the market is worried about the earnings trajectory, and that is what we believe, apart from the external factors, is impacting markets. We've had a great run in terms of earnings for FY23 and FY24, where every quarter you would continue to see earnings upgrades. However, the first 2 quarters of FY25 have seen earnings actually getting downgraded, and the outcome has been muted in terms of single-digit earnings trajectory. For FY25, now consensus expects single-digit earnings growth, and for 26, expectation is of mid-teens earnings growth. I think a lot depends on how the second half of the year plays out in terms of both consumer demand as well as government spend in terms of capex. And that will possibly determine the way markets move over the near term. But structurally, to answer your question, we believe that markets are still very well placed, and India continues to fairly shine out as an oasis in the desert in the global equity markets.
Right now, with so many investment themes emerging, which ones do you see as having the most potential, and which might be just passing fads?
Well, if you look at the way we have looked at, and it's the end of the year, so we put on our forecasting hats and we try to look at what will be the best themes that we can play for 2025. So we've identified 5 key themes, which we believe are structural themes. Now, some of them are something that we've spoken of earlier, which includes segments such as infrastructure, manufacturing, and capex. While, of course, near term, there has been some amount of slowdown in public capex, we believe that private sector capex is likely to pick up, which remains a structural theme going over the next couple of years. The other 2 segments, which we incrementally believe are segments or themes that need to be watched out for. One is technology. Here, there is a structural element. Whenever there is a change in terms of technology adoption, and this is something again that we've seen over the last 2 decades, Indian IT companies typically gain in terms of market share, and there is revenue growth. And here we are at the cusp of a change in terms of adoption, which is through AI and Gen AI. So this is a structural opportunity. Near term, US markets and US economy being buoyant and better than expected outcomes on macro means that hopefully in FY26, you should start seeing revenue growth improve for IT services players. So that's one theme that we are playing. The third theme is healthcare. Here we believe that healthcare as a sector has become diverse. India started out as low-cost generics provider to the world in terms of drugs. And then there was this branded formulations opportunity for domestic players. Today, there is a larger opportunity apart from these 2 segments in terms of healthcare and hospitals, for instance, where there is need for increasing capacity in that segment. And companies clearly are seeing better growth and better profitability, as well as India gaining a share in the global pie where both API manufacturing and CDMO as a segment goes. So healthcare becomes a large theme to play. And the final theme that we are looking at is essentially financialization of savings. This we believe is something that is likely to continue. There's been a lot of debate about, how equity in the overall financial savings pie has gone up at the cost of deposits. However, my belief is that even today, if you look at equity investments, the number of investors, both in mutual funds as well as direct equity, the number is still very small in context of the universe that is present in terms of the number of people who can invest in equities. So therefore, this theme, which can be played either through some of the large private banks, which are trading today at reasonable valuations, or through companies which are direct plays on the capital market asset management segment. This is a theme that we believe will continue going into the next couple of years. So these are some of the structural themes that we have identified for 2025.
And any theme which you think which are fads, which has done well and which are unlikely to go up going forward?
So one segment, I wouldn't call it a theme, but I think one segment of stocks which have done really well, and this is something that we have seen across large, mid, and small, has been stocks where free float has been low. And if you look at the last couple of years, you would have seen that in various segments, including some of the public sector names, where stocks with low free float have done extremely well, but fundamentals have typically not kept up, which means today they are trading at significantly higher valuations. And therefore, when you construct the portfolio today, we are looking at three key things. One, look at quality over momentum, look at reasonable valuations over companies where valuations are stretched. And third is look at companies where free float or liquidity is high as compared to companies where free float is very low. And these companies which have typically done well. And what we've seen is if you split those companies, large, mid, and small, in the last 2 years, they have run up considerably. So I would say that that is one segment that one should be careful of and possibly avoid.
Shivani, other thing was many emerging investment themes exhibit extreme valuation yet offer significant growth opportunities. How do you strike a balance? Does prioritizing growth means compromising on valuation or vice versa? Do you have a framework to navigate these trade-offs?
Absolutely. So this is something that we grapple with on a regular basis because you do have many emerging themes, as you say, or new companies that have come into listing or new sectors that have come into listing where you may not have a pinpoint in terms of what is the ideal valuation benchmark for that company, given that it's a new area or a new segment that has come into the public markets. So a few key things that we look at in such companies. One is that when you are evaluating growth, you need to be very cognizant about what is the target addressable market, which is TAM. Secondly, you need to also be cognizant about the entry barriers into the segment, right? So you have to be understanding the competitive intensity, which can impact market share and growth. Third is companies have to exhibit path to profitability. Gone are the days when growth alone can drive valuations. If the path to profitability is not clear, then valuations do not sustain for a long period of time. And path to profitability means actual delivery in terms of bottom line, right? So that is something that now one has to be extremely clear about. And finally, capital allocation. What we've seen is that many companies which have been high growth companies in the past have faltered on capital allocation, and that has had a bigger impact on valuation. And therefore, capital allocation and being fair to minority shareholders, that's the third criteria that we keep in mind when evaluating companies. But our framework, Chirag, as we were discussing, is that finally you have to have growth, but valuations have to be reasonable for you to be able to buy that growth. If you are buying growth at any valuation, the chances of you making a mistake are higher.
Right. Another thing that we would like to understand here, how do you prioritize investment themes? Attempting to capitalize on every theme can lead to an overly diversified portfolio. So what is the criteria that you use to choose one theme over another?
So you're right. So you would obviously have, like I said, we've outlined for ourselves four key themes that we want to play for the year. And
Right.
within those themes, you decide on sectors which can best represent each of the themes. Now, when we are running a portfolio, the portfolios I run, for instance, on focused, clearly there is no over diversification because it's a 30 stock concentrated portfolio. And so it's more bottom up in nature. In Contra, as a strategy, we have a eye in terms of the number of stocks in the portfolio. So typically the number of stocks will be anywhere between 60 to 65, which is more optimal for a diversified portfolio. And within the picking of themes, for each of the sectors, we have sector analysts who then give us a view in terms of what's the upside potential in a particular sector and also stocks within the sector that he or she may track, which helps us prioritize that, you need to play a larger overweight on a particular sector or theme vis-a-vis some of the others. So I think at the end of the day, as a fund house, research is the backbone of portfolio construct. And given the fact that we've over a period built a very strong and stable research team, Our team comprises of analysts who are seasoned analysts. The average work experience of these analysts are close to 14 to 15 years, which means that they have seen cycles and they understand their sectors well. So typically an analyst will track anywhere between 2 to 3 sectors. And that means that a lot of experience comes in terms of taking sectoral calls at a fund house level. And I think, as I said, having a strong research team helps you in terms of portfolio construct. So what you see finally is the outcome, but the research and the work that goes behind creating that outcome is a lot of work and a lot of effort that is put in by the research team as well.
As discussed earlier, we have seen markets going up fairly in the last 2 3 years. So how can investors get how can they get the contra opportunities in this kind of market? Do you feel there are opportunities available in the current market scenario?
Yes, absolutely. I think market always presents opportunities. So for an investor who is looking at markets today, what we are advising is a few things that, maybe I wanted to discuss on your platform. One is, given where valuations are today, the risk reward between large, mid, and small is slightly tilted towards large caps as compared to mid and small caps, just on the basis of valuation. We are not saying that you stay away from mid and small caps considerably or completely, but we are saying that the portfolio tilt should be somewhat large cap as compared to mid and small cap. Equities, clearly, the way to invest in equities continues to be more systematic and through the SIP route, which gives you a period of investments over a long-term horizon. And the third aspect that what we are telling investors is that if you want to invest lump sum into the market, look at either schemes or segments. For instance, the category of multi-asset as a category, which allows the fund manager to do asset allocation on your behalf, is something that investors can, evaluate. Or for instance, contra as a strategy where ultimately the valuation of that portfolio gives you some amount of comfort, especially in times of volatility, because it's a value biased portfolio. So net, what we are really telling investors is you need to continue to stay disciplined where it comes to equity investments. Keep long-term investments in mind. Keep your risk profile and your investment horizon based on your needs intact, but also approach the market keeping in mind asset allocation. And overall, from an equity perspective, given where valuations are today, we are saying equity should be neutral in the overall asset allocation bucket with a slight bend towards large caps as compared to mid and small caps. So you would see across most of our portfolios, including focused and contra, while we do have mid and small caps, there is a slight bend towards large caps in the portfolios as well.
Right. And what are some of the common misconceptions or misinterpretations about contrarian investing? And what are the principles that you think should investors follow when exploring contrarian strategies?
So first and foremost, I think when you're investing in a contrarian strategy, you need to have patience because a strategy by itself is contrarian, right? And therefore, for that thesis to play out, it may take time. So for instance, if you are investing in a company today which has undergone some amount of pain, either from a sectoral perspective or a company specific perspective, and we now believe that that has bottomed out and things will start to improve, which will lead to multiples re-rate for that particular company. However, it may take time for that thesis to play out. So one has to be patient in terms of when you're investing in contrarian strategies such as ours. The second factor is that every contra strategy need not just be a value strategy, right? There is a value bias to the strategy. However, on top of value, there is an overlay of growth, but at a reasonable price, and quality at a reasonable price where we manage contra. So it is not just value, it is value plus. So that is something that most investors need to also keep in mind when we are looking at Contra and Kotak Contra Fund as a strategy. And the third aspect for Contra is that Contra, when we are picking stocks and we are picking or we are constructing the portfolio, at that point in time, we are true to label and we will follow each of those 5 rules that I had outlined for you. And those stocks will have to meet those criteria. However, once the stock is in the portfolio and the stock may perform, it may not necessarily be removed from the portfolio. And therefore, the portfolio has to be evaluated, keeping that in mind from a strategy perspective as well.
Shibani, this Kotak Contra Fund follows a contrarian approach, while the focused fund targets the high conviction ideas. How do you balance staying true to these two distinction objectives while adopting the evolving market conditions?
Chirag, I must admit that it is a challenge, but I enjoy taking up challenges. And this is something that I think, when I was first approached and, they said that I was already managing Focused at that point in time, and I was given the opportunity to manage Contra. My initial reaction was that how will I manage it? Because the strategy are slightly divergent, right? And as you rightly pointed out, one is a concentrated growth quality at a reasonable price, and the other has a value bias. But I think that given that I have been a research analyst for the last 2 decades, I have looked at stocks across two large sectors, IT as well as banking, and I've looked at stocks both large, mid, and small. And I've always tried to identify stocks based on the upside, downside risk potential that we were discussing. And I think that helps us or has helped me in terms of being true to label where both these strategies are concerned. So on one hand, given that I also head the research team, I'm able to identify the 30 best ideas that we have from our coverage universe, which form the part of the focused equity strategy. On the other hand, given that today we are tracking more than 500 companies in our research universe, given that Contra is a more diversified strategy, it also gives me the opportunity to pick stocks from a large basket of stocks. So today, for instance, we are tracking almost 90% of India's market cap. And therefore, the number of stocks that you can pick from is fairly large. And that helps in terms of construct of the portfolio where Contra is concerned. And, Chirag and Ruchira, I think you guys know that whenever there is something challenging, it makes the job and the outcome more fulfilling. And I think that's what has been my experience. And I totally enjoyed it.
Right now, the performance margin of your Contra fund against the BSE 500 benchmark has narrowed, while the focused fund has shown an upward trend over 1 year rolling returns from December 2019 to 24. So does this signal a potential resurgence of the growth style in your view?
I must correct you a little bit here. Contra continues to outperform the benchmark. The benchmark for Contra as well as for Focused is NSE 500 TRI.
All right.
So that's the benchmark. And Contra continues to outperform significantly vis-a-vis the benchmark. And of course, as I said, as a style, Contra is more diversified while Focus is concentrated. And while we try to pick the right stocks for Focused as a strategy, sometimes it takes a little bit of time for these theses to play out. And given that Focused is a very concentrated strategy, there will be periods of time when maybe one particular stock does not perform or a few stocks don't perform. And that leads to some lead lag where the benchmark performance vis-a-vis the benchmark goes. But however, of course, our endeavor is to create alpha for whichever portfolios we manage. Contra continues to generate significant alpha over 1 year, 3 year, 5 year period. Focus, as we were discussing, is now generating alpha over a 1 year period as well as since inception and is in line with benchmark. And if you look at it from a 3-5 year perspective, and if you look at it on a rolling return basis, Focus is also now generating alpha over time periods.
Shivani, the focus strategy, like a typical focused fund, is heavily tilted towards the large cap, while Contra Fund has more balanced approach towards large, mid, and small cap. What drives the difference in the market cap allocation?
So here one also has to keep in mind liquidity in terms of picking stocks. More coming to the question from a focus standpoint, these are the best ideas. Of course, we don't have a market cap constraint where focus is concerned. However, what we are trying to do is create a very concentrated strategy in terms of composition of the portfolio. So therefore, that has some bearing in terms of the kind of stocks that you want to pick in the portfolio. Having said that, focus typically has been run with a slight large cap bias, say 70-30 kind of a mix, while Contra is today being run with about a 60-40 mix where large cap vis-a-vis mid and small cap is concerned. In terms of stock picking from a focus perspective, given that our house view today is that large caps offer better risk reward as compared to mid and small caps, there is a bent of that portfolio slightly more towards large caps. But ultimately, the composition of the portfolio is largely bottom up in nature. So wherever we find that there is opportunity or there is upside, keeping an eye on the downside, that's how we typically compose the portfolio.
Just wanted to get your view on, your sector outlook. So both your funds are overweight on IT stocks. With, as we discussed, with AI advancements reshaping the industry, how do you see the future of Indian IT sector?
Ruchira, a very interesting question, because IT is a sector where we increased our positioning and overweight stance maybe a couple of quarters ago. So let's take a step back and look at what actually has happened in IT as a sector. So when COVID happened, many companies globally spent a lot in terms of technology because they believed that technology was the way to go. However, there was excessive spending on technology. And when economy and growth slow down for global countries and economies of the world, including North America and Europe, companies started to pull back on discretionary tech spend, right? And therefore, we saw that last year was a period of challenge for the sector where growth considerably slowed down. So you saw a period of mid-teens growth in post-COVID period, and that growth completely plummeted. Now you have a situation where in large economies of the world, including North America, which contributes significantly to revenues of IT services players, there is some amount of macro stability. In fact, growth has held up better from a macro perspective than what was earlier anticipated, and rate cut cycles have started, which means that many companies that have cut back on discretionary tech spend over the last couple of years are re-evaluating their spends. So spends can be divided into two parts. One is to grow the business, and the second is to run the business. Run the business spends were always happening, while grow the business spends were absent. And the basic thesis that we have is that in the next year or so, some of this grow the business spend should come back. And IT as a sector is very, very strongly correlated to revenue growth or top line growth. And therefore, our thesis on IT in the near term is based on that. And as you rightly alluded, that there is a structural opportunity from an AI adoption perspective, which should also help in terms of the sector on a slightly longer term basis.
Now, coming to the banking sector, the Nifty Financial Services Index has underperformed amidst the challenges in banking sector. When do you expect a turnaround? And as a bank-owned AMC, what unique perspective does the Kotak Mahindra bring to the table, especially after launching the banking fund in 2023?
Yeah, so I think one big factor, or actually there are two things that have changed where banking as a sector is concerned. One is we've noticed that the sector itself has become very, very large. It's a diversified sector. There are different segments of the sector which are now listed in the public space. So many, say 5 years ago, there were hardly any plays where capital markets were concerned, asset managers or wealth managers were concerned. Today, you have banks, you have public sector, private sector, small finance banks, you have NBFCs, microfinance, housing finance, and the like. Then there is insurance, etc. So the sector itself has become extremely diversified. If you look at the period between, say, 2010 and 2019, the sector performance was extremely homogeneous. That meant that only the private sector banks, which were a few names, were clearly outperforming and driving performance. However, since 2020, different parts of the sector performed differently at a point in time. So you will see that last couple of years, public sector banks had a great run. Last year, some of the NBFCs did well, some of the capital market plays did well. So every segment of the segment or the sector does not perform in the same way. The sector has become heterogeneous. So these are two characteristics that we have observed over the period of time. So then when we are constructing the portfolio for the BFSI fund, it is important not just to look at the benchmark, which is somewhat skewed, however, to look at segments within the sector which we think can outperform. And the idea is to, if you are able to identify the right segment, you will then be able to create alpha over the benchmark. Coming to our view, we believe that today, of course, the sector itself and banking as a sector has gone through significant headwinds. You saw deposit growth come off, then you saw margin pressure, and today there is asset quality stress in certain pockets of unsecured lending. But if you look at the large banks, both the large private banks and the large public sector banks, these are banks which have a diversified loan book. Many of the larger private banks have been gaining market share in loans and deposits. And today, if you ask me, the segment of the market where valuations are extremely reasonable is this particular segment. So downside risk, we believe, is limited. The upside may take time because there are still headwinds to navigate. However, from a risk reward perspective, if you have a 24-month horizon, this is one segment where valuation support is clearly there, and therefore downside appears to be protected.
Right. Now, one last question. The Contra Fund's allocation to PSUs we saw has dropped from 24% to 16%. So if you could share with us what factors drove this strategic shift?
So, Ruchira, when we are evaluating PSUs, we are not evaluating PSU as a homogeneous pack. We are evaluating PSUs based on the sector in which that particular company is operating in. And we are also evaluating each company on its own merit using our framework that we were discussing earlier. So yes, there was a certain amount of weightage that was given to public sector undertakings. However, this segment also saw significant outperformance over the last year and or maybe almost 2 years. And therefore, there has been some amount of profit booking that has happened, which has brought down the weight in that particular segment. But again, to reiterate, when we are looking at PSUs, each of the companies are evaluated just as we evaluate any private company as well. So based on underlying profitability and valuations. And hence, at points in time, of course, there will be some amount of profit booking, etc. But the composition of the portfolio, whether private or PSU, in terms of stock picking, remains exactly the same.
All right. Well, with that, it's time for us to wrap up this chat. Thank you, Shivani, for taking the time for this interaction. It was lovely speaking to you. Thanks.
Thank you so much, Ruchira and Chirag. It was wonderful and a very, very insightful set of questions that you had for me. It also helped me introspect quite a bit. Thank you. Enjoyed the chat.
Thanks.
Thanks.